Hello and welcome to Stock Market for Ordinary Investors. So I'm talking to ordinary investors and not traders or successful investors, big time investors. So this video is exclusively for you. You are a salaried class person, an ordinary investor, a small businessman, and or a retired person who is going to invest his savings in stock market. So this video is only for you. So here's the outline of my discussion. I'm going to define my audience and I'm going to give you a few warnings about how to invest in stock market. I'm going to give you getting started advice, and I'm going to tell you how to select the shares that you want to invest in, and then I'm going to tell you uh, basics of your investment strategy and how to deal with ups and downs of the market. So let's begin. So who are you? I mean, who is my target audience? My target audience are small investors, beginners, salaried class savers, retired people, having no experience of investing in stock market, and people like myself who want to improve their skills in stock market, so they don't have a lot of time or they don't have a lot of money, but with whatever they have, they want to learn as well as invest their savings for future. So warning. The first and the most critical warning is that stock market is not a regular fixed income scheme. So you should not invest. You should never invest all of your savings in stock market, and it's not a good idea to invest a very big amount in the beginning in the stock market as well. So if you have not played this game, don't invest a big amount in this market. So you should begin small and keep investing small amounts on a regular basis for a long time. That's the good way to go in a stock market. If you do it otherwise, if you come and you become excited and you invest a big amount, then you are acting like a gambler, and you are a bad gambler at that, because you don't know what exactly you are doing, what are your prospects, and you may end up losing. So the first rule is, and the foremost warning is that learn the game before you play big or you start playing big. So uh, my second advice is that stock market investors need to have lots of patience. So if you don't have the patience or stamina to invest in stock market, don't invest. So stock market is not a 2020 game in cricket. It's not even a 5 days test match where you might invest at the beginning of the week and you might get good rewards at the end of the week. So it's more like a 5 to 10 years test match. So that's what you should keep in mind, that the shares that you are going to buy today, it's possible that for next 5 to 10 years you are not able to earn anything out of that or earn any decent profit out of that. To learn about that, I mean, you should look at Warren Buffett and other investors who have patiently invested for over 40 years, and that's the reason that they have earned a lot. So another thing to keep in mind is that not all of your investments are going to be profitable or successful. But if you make 10 investments in 10 years or 20 years, and one or two of them go really big, then that's more than good enough to cover all 20 of your investments. It's not to say that maybe the rest of them might be bad, but maybe they are not as successful as one or two of your really great investments. So, have plenty of time, have plenty of patience, and do not invest big at the beginning. So, keep investing small amounts for a long time is a good strategy to get started. So, okay. Another key point for getting started is that you should only invest a small proportion, maybe 10 or 20% of your savings in stock market, and not more than that. rest of your savings as a small investor can go into a saving account or something else where you can access them in times of need. Okay, and the next key point is you need to select a broker for investing in stock market. So investing a broker is a very important choice that you have to make. So don't take this decision lightly. So what you need to do is you need to first research on Google or ask your friends and other knowledgeable people about who are the top three or top five or top 10 brokers that invest in your stock that operate in your stock market. So among those brokers you can and should select one of the top brokers that has the best services and gives you a great uh, rates for investing as well. So I mean, in terms of the charges, they have optimal charges or lowest possible charges, and they can give you best security for your investment, best tools for your investment, for managing your investment, and so on. So once you have selected your brokers, and when you register with them, they would ask you if you want to go with a trader option or without a trader option. So I would suggest that it's very important that you go without a trader option, or if you take trader option, then you keep the investment decisions for yourself. So if you are someone like me who wants to learn the game, then as well as who can from time to time do some research as well. So I mean, it's better. It's best that you basically go without a trader. So I mean, let's move forward. Then the next, so you have selected your broker and you have selected your trading option, and you have in mind that how are you going to proceed with your investment. So you have a basic strategy. Then you need to select shares, which shares to invest in. So there are plenty of websites, you can Google them, where you can find investment information about shares to invest. So the shares that you want to invest in are those shares that offer decent returns on your savings. So for example, savings are invested. For example, you want to select shares that have good DPS, that have good EPS, uh, and that have in general very good future prospects, and they have fair prices as well. So let's say you keep tracking or you start tracking 20 different shares, so you note down their DPS, their EPS, what's the fair price to buy, what is their 5 years high, 1 year's high, 3 years high, and so on. And then you compare their current price with them, and afterwards you select the share which is you know at a great price to buy, and which is likely to go up in future. So then you buy some of those shares. So I mean, uh, that's the first thing to do. Then the next thing is, you don't, as a small investor, you don't want to invest in 20 different shares. So you want to only invest in 5 to 10 shares, because the 5 to 10 shares that you invest in are those that you want to keep supporting in future as well, regardless of price fluctuations. So what is your investment strategy? So our investment strategy is that we are going to stick with 5 to 10 shares or stocks, and then we are going to keep track of the prices. So if the price goes down, then we have to define the next level where to buy. So let's say the price was 80 when we bought net sold, but now the price is 50, so maybe we should buy some more shares at 50 as well. This is called averaging strategy. So our average will be the total investment at rupees 80 plus total investment at rupees uh, 50, and then divided by the total number of shares that we have. So we want to basically minimize the average price for which we have bought the shares. So that's our primary goal. Another way to minimize the average price is part selling. So for example, you bought some shares at 50, but then again the price of the share, whatever, net sold or whatever, it went to 70. Then you sell the shares that you buy at 50 at rupees 70 and earn some profit. Maybe then you invest in some other share, or maybe you keep that money and keep waiting. Maybe the net sold comes back down to 50 again, and then you again can buy that. So that's one way, and same you can do the same if the prices of the uh, your share goes up. So you buy some shares at 80 and then they go up, you uh, buy them again at 100. Maybe you expect them to go back to 160. So you keep buying shares and increments, and do not buy shares a lot of them at one point. So, and you keep doing this for 2 years, 3 years, and at the end of the day you have a very good average price for that share, and you have a big quantity of the share as well, if it especially if it does well. Otherwise, I mean, if it does not do well as you expect, then probably at some point when it suits you, you can get out of that share as well. So you have to invest for long term. You have to invest in small increments at different points in time. You have to select a good broker, and that's how you invest in. Uh, you manage your investment strategy along with averaging strategy, and part selling strategy. You should also have a stop loss strategy. So typically a stop loss is that you are keeping track of a price, and if it falls below certain level, then you have to sell it. uh, I, I would suggest that rather than doing it in a short time window, you do it in a long term window, along with certain criteria. So let's assume that you have a share and it's doing very well, and its price falls, then there is no need to apply stop loss strategy on that. You keep track of the prices and you buy some more at some other level. But if you have a share that a company that goes into losses, and you think that it has gone into losses for a long time and it's going to take a year or two to recover from those losses, then you apply your stop loss strategy. So for example, you bought something at 80, and then you average it out and it's like 60, and the price goes down from 100 to 80 or 70, then you sell it at 70 to save yourself, especially if the company has gone into losses. You can again buy it at some point when the company recovers from the losses, and it has a good price, like maybe 40 or 30. So you can buy that share again. So along with all these things, I mean, investing gradually, selecting a good broker, selecting good shares to buy, avoiding shares which are garbage. So garbage share are those which are not making any profit, and they have extremely low prices, and all the people are betting on them. So you don't want to invest in those garbage shares. So okay, what else? And you have a stop loss strategy, which basically says that if a company goes into losses and its share prices crashes, then you need to get out of that at the right time. So that's this is all the advice that I have for you guys. Also, in your spare time, you should read about, I mean, those companies, look at their reports. Also, you should always read their quarterly reports, their annual reports. Okay, and one other thing, if you are going to invest in 5 to 10 shares in your lifetime, or maybe for 5 to 10 years, uh, then you should read about them, and you should keep your investment portfolio as broad as possible. So if you buy one or two shares in energy sector, then you should buy one or two share in fertilizers, and one or two share in cement and so on. Or maybe you should invest in IT sector as well. So so that's how, I mean, if you have five, six, or eight shares, then you should invest in four, five, or six different sectors as well, or maybe three or four different sectors as well. So so don't invest all your money in one sector, in order to diversify your portfolio so that you can keep up with ups and downs of the market. Thank you very much. Do like my video, do share my video, and give me feedback, so that I can make more videos for you guys. Thank you very much. Thanks for watching.